Welcome everyone. Welcome to this episode of Technical Strategy. I have with me Mr. Dharmesha, and this episode comes at a time which cannot be any better because इतने confusing times हैं. We saw a 5 month losing streak, and then when the market finally rebounded, so it has rebounded like anything beyond anybody's expectations. We are right now, as we speak, sitting at around 24,000 levels. And यहाँ से क्या होगा is a question that is on everybody's mind. And for that, we requested, of course, Dharmesh sir to help us out. Sir, what is the outlook on markets right now? What does your technical strategy say?
So, good morning, Vishu, and thank you for inviting me on this show of the market outlook. Yeah, definitely. I think so. If you look at the market for last 6 months, it's been too volatile, and there may be lots of negative news happening in the market in terms of U.S. elections. Post U.S. elections, we have great tariff. I think so. That was bond yield climbing to 4.75, 4.85, and you have many things like dollar index, which was the main villain of this fall for last 6 months, which moved from 102 to 110. I think so. Keeping all things together, it looks like most of the negative news seems to be getting priced in. As if you look from the structural point of view, we believe India is in a structural bull market, and inside the structural bull market, corrections are part and partial. What we observed, the correction was almost 17% from the top of 26,300. But something interesting data I have to share with you in last 2 decades have been that if you look at the historical trend of the market, inside the structural bull market, 16 to 17% correction are the normal correction. And post that market has a tendency to move on the higher side to make the new high. And this correction, if you look last for 7 to 8 months historically. And if you look at the current context, I think so the correction is already done with 17% from the top, and almost we are the eighth month of the month of April after making a top out in September 2024. We believe going forward things looks positive in terms of trade tariff after the news of pause in trade tariff for next 90 days has seen a change in sentiment in the market, and that is seen clearly in the price performance. If you look from the India perspective, I think so. Yes, definitely many things are looking more positive in structure back from the macro point of view. Like if you look at the dollar index has seen a good correction from 110 to 102. Apart from that, Brent crude, I think so the one which is most important to watch out for, I think with that I've seen a good correction from 85 to almost 55, 58. And we believe going forward, crude is likely to see a more for consolidation. So yes, apart from that, again bond yield and most important was I think so the interest rate cycle peak out. I think so. We have already seen the India inflation is coming off, and we have seen a good rate cut happening. Two rate cuts already done. An expectation of two further rate cuts going forward. I think so. Keeping all things together, it looks like India is in a much better place relative terms compared to the world. So yes, going forward, we expect Nifty to head towards 25,700 to 25,500 is likely target for the Nifty based on the historical trends. Because if you look at whenever the market has seen a correction of 17% post 7 to 8 months corrections, historically the average return for next 3 months on the Nifty from the bottom is almost around 15 to 17%. If I pick up the bottom, assume the bottom of 21,900, which we expect the market has seen the bottom, we are already done with the bottom. We believe the target is almost 16% is something around 25,500 to 25,700. So yes, Nifty will remain to be structurally positive. And one more interesting data point to share with you in last 2 3 days has happened that both Nifty as well as the bank Nifty both have witnessed a faster time retracement. In terms of Nifty to talk for, the 9 trading sessions get decline is getting retraced in 66 days time free. So almost it clearly showing the faster retracement and the change in sentiment supported by strong market breadth. I think so all things putting together and a positive RSI divergence was also visible on the weekly chart. So something I think so to talk for from the medium term perspective, we remain to be constructive positive for the market. Yes, volatility will be there. I'm not denying that we will see the V-shaped recovery. It could be more of a U-shaped recovery. But such volatility, I believe, you can say that uncertainty always gives you the best investment time, and that is already proven this time also because whoever is bought at the month of March I think so. They are sitting right now in the banking side to top for particular, I think so, with almost good gains of almost 10 to 15%. So yes, things looks positive. By the day should be the strategy. The strategy which was working for last 6 months was something like sell on rallies. I think so. That stance seems to be getting changing to buy on dips should be the strategy, where 21,900 to 21,500 will remain to be the very strong support. So any dip should not be constructed as negative, but should be looked as a buying opportunity.
Absolutely. And how do the broader markets look right now?
If you look at the broader market, I think so. Broader market also has their own historical trend, and to understand the market, I think so. You need to connect the dots, and to connect the dots, you need to know the how the history pan out. If you look at the historical trend in the mid caps and the small caps for last 2 decades, the historical corrections always in mid caps and small caps are on an average have been around 26 to 30%. And post that, we see a more of a base formation happening. And post base formation, you see most of the times Nifty, mid caps, and the small caps have a tendency to make a new high. So we believe, so if you look in the current context, the correction which happened in the mid caps and the small caps, mid cap was corrected almost around 24 to 25%, then small cap was corrected around 29 to 30%. So both the way, if you look, I think so, price wise correction seems to be done for the both the indices. Maybe time wise, we can see one more quarter of a more of a base formation, and this base formation is very good for the market. It makes the market more healthy, and it is getting a setting up a stage for the next leg of upside. So we believe, I think so, for the mid caps and the small caps, we will see a more for stock specific action as we are already into earning season. So we will see more for stock specific action likely to continue for the mid cap, but we believe one should definitely look at the good quality businesses at the current market price. I think so. This is the right time to invest in the mid caps and the small caps, because too much of pessimism is always a good time to invest. So we believe, I think so, things looks much better going forward for both mid caps and the small caps.
Absolutely. Sir, the recent correction that we saw was a lot of it was attributed to FIIs selling. And the recent uptick that we have seen, the sharp uprise that we have seen, there also FIIs seem to have been buying a lot. How do you interpret this?
If you look at the historical trend, again back to FIs, I think so. So what data we have done some analysis on the FI side is that whenever we have seen the selling of more than 30,000 crores from the FIs in the single quarter, post that 1 or 2 quarter plus minus, we have most of the time seen FI come back to India in terms of inflows. So we will, I think so. If you look at the last 10 days data of the FIs, the selling prices seems to be getting decelerated. I would say it is in a declining trend in terms of numbers, and slow but steadily we are seeing some bit of a improvement in numbers in terms of buying from the FIs. So if you look at the historical trend, I think so it clearly shows that post sharp sell off from the FI side in a single quarter for more than 20,000 crores. Most of the times, FIs plus minus 1 quarter should be ignored. Come back in a very large scale. So we believe, I think so. There is not Days are not so far, that we will definitely see. I think so. FIs will come back maybe post August at this earning season. I think so. We should definitely see. I think so. Things should get better from the India perspective.
Absolutely. Sir, what about our targets for Nifty mid cap and small cap?
So if you look at the mid cap and the small cap, as I already mentioned, we see that if you go back to the history, I think so the average corrections have been around 25 to 30% for both mid caps as well as small caps. And we believe, I think so, if you look at the current context, we already done the corrections in the terms of price performance, where 25% is already done with the mid caps, and almost for the small caps, it was around 29 to 30%. Going forward, we believe, I think so, things should get into more better for mid caps and small caps. As far as mid caps are concerned, yes, they can enter into a more of a consolidation to base formation, where we believe for next 1 quarter, we could see a more of a sideways movement to stock specific action till the earning season gets over. Post that, definitely we believe, I think so, midcaps should see a catch-up exercise, and we should be looking for midcaps to talk for, I think so, 55,000 to 55,500 is likely to target for the midcaps. As far as small caps are concerned, yes, definitely we believe, I think so, 17,000 to 17,500 is likely target for the small cap index. So yeah, both the indices should go into consolidation with stock specific action till the month of May, and maybe post June, I think so. We should definitely see action picking up in both mid caps and the small caps.
Right. And so, of course, all eyes right now are on the US market. So, could you help us a little bit with maybe S&P 500 and the dollar index?
Yeah, so if you look at the again, if you look at the historical data back to the US also, I think so. US has a tendency to correct 16 to 20% on an average, and post such corrections, they generally enter into base formation, and maybe post base formation, you definitely see the rally picking up in the US. So yes, right now, if you look at the US has been the outperformer market for last 6 months when India has been struggling in last 6 months. I think so. The only market which was outperforming was US market, and so what we see is excess buying is getting translated into some bit of a selling pressure of booking profit. And so things in the US till we see a more of a clarity in terms of negotiations, in terms of tariff, I think so. We expect US market to consolidate for some more time, and it will not be in a hurry to see a upside in US market. So we believe, I think so. Yeah, things except apart from US looks much better globally. Like if you talk for European market, I think so they are looking much better in current context. And apart from that, I think so India is the only one in the emerging market. India, China, I think so the one where we definitely see a more of a gradual upmove happening going forward. One more point to add here is that the dollar index, I think so the main culprit of the Indian market fall was dollar index. I think so from 100 to 210, we have seen a good movement happening in the from Jan to almost March, and that has seen a sharp reversal happening. And maybe I think so. We believe I think so. 90, 101, 102 has been a very strong support for the dollar index, which has seen a good breakdown at currently trading at 99, 99.5. We expect dollar index to head towards 90 to 94 going forward. Maybe it may not be in a hurry. We'll take them some more, one more year, I would say, 1 year, where dollar index should be heading towards a target of 94. So that again will act as a tailwind for the Indian market because of fall in the dollar index is something bit positive for emerging markets, and that dollar index is metal index is always a inverse correlations with the dollar index. Again, a fall in dollar index is something a bit positive for metal index, and let us not forget that the index has been underperforming for a long time for last 2 3 years. So we believe I think so that could again act as a big positive for metal index. So overall, I think so a fall in dollar index is big positive for most of these emerging markets.
Absolutely. With that all out of the way, sir, let's talk about which sectors actually present a good risk reward ratio and where should investors look out for?
Looking at the current circumstances, I think so in terms of trade tariff war, I think so. We believe I think so one should more focus towards the domestic theme rather than the external global themes. So yeah, we focus on more for domestic themes like banking, as I said. We believe I think so banking should be the leader, which is having a 30% weightage to the Nifty, should be the leader of this rally, and it should continue as already I seen that the bank Nifty has witnessed a sharp faster retracement by the 6 months of decline getting retraced in just 2 months. So the way which clearly shows I think the powerful or the power of a buying in the bank Nifty going forward also. They should not get fizzled out, I would say, in 1 or 2 months, but should continue for next 1 or 2 quarters. So yes, I think so things should get better for bank Nifty, which is again a positive for the Nifty. So apart from bank Nifty, PSUs again I believe, and I mentioned last time also in your show that PSUs are the leaders of this bull market and they continue to be the leaders. Yes, there are intermediate corrections which happens inside the bull market, and that is what is happening with the PSUs. So we believe PSUs as a sector looks positive going forward. Apart from PSUs, again PSU banks, defense, railways are the ones which should see a catch-up exercise going forward. Pharma, again, constructive positive for pharma, especially for CDMO play. I think so. The one should definitely look out for. So pharma is again one which we like in terms of even relative outperformance. Pharma is doing better, and yes, it has some bit of exposure to US, but overall, I think so. Things look much better for pharma going forward. Metal, as I said, that the dollar index has always a inverse correlation with the metal index, and that should augur well for metal. Apart from metal, the risk reward where if we see a favorable at current market prices capital goods and infra. Now, let us forget that, don't forget that the government is changing in terms of budgetary amount from the government side. So again, capex is something the capex cycle should pick up from the year on, and that is clearly visible in terms of numbers. If you look at the cement numbers, I think so clearly shows that we are already seeing a pickup in the infra. So we believe, I think so, things should get better and better for infra and capital goods going forward. So here also we have seen a good correction of almost 30 to 40% from the top. So the risk level looks more favorable for infra and capital goods. Last but not the least is IT sector. Now coming to IT again, there is a lot of noise of in terms of US, I think so, slowdown, recession. That is something putting pressure on the Indian IT companies. But we believe, I think so, going back to the history on technical side, on data point, because we believe, I think so, data is something most important in this market, and that is working fantastic, even in this current volatile market. So if you look at the IT index historical trend since inception, the average correction inside the IT is almost around 20 to 34%. There have been 3 to 4 major corrections. And post those corrections, IT has a tendency to enter into base formation or consolidation and most 1 or 2 quarter. And post that, we see more of a gradual up happening in IT index. If you look at the current context, it has already seen a correction of 34% from the top. And even after this Infosys numbers, I think so we are not seeing any negativity. I think so looks most of these are getting into pricing. So most of the negative news seems to be getting pricing for IT. Any minor positive news from the US market can see a spot in the IT sector. So yes, right now it's a more of a shopping time, I would say, for IT index. We will not see a V-shaped recovery, but it's a good time to construct the portfolio in IT sector because most of the stocks, if you look, are seeing the 30 to 40% correction from the top. So I think so in terms of IT, we believe, I think so, we will not see a V-shaped recovery, but more for U-shaped recovery. But from constructing the portfolio, if one is having the patience, I think so, to hold on for next 6 months to 1 year, this is the right time to look at the IT sector. So IT, I believe, I think it's more for risk level looks more favorable at the current market price.
Absolutely. Well, that was it for this time. Thank you so much, Dharmesh sir, for your insights. I hope you'll allow us more such session in future. And thank you so much, everyone, for watching. If you have any questions, please put them down in the comments and we'll try to get back to you. Thank you so much, everyone.
Thank you.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.